Good morning and welcome to Charting the Markets on Tuesday, the 30th January 2024. Asian markets overnight basically ended in negative territory as the ongoing collapse of Evergrande, the world's most indebted property developer, weighed on Asian equity indices, and also as the prospect of a new security law in Hong Kong worried investors. And we could see the impact of that on European equity markets earlier this morning, which also came off their highs as Eurozone GDP data basically showed that there is zero growth quarter on quarter in the fourth quarter of last year in the euro area. And as the growth over the whole year on year, has only risen by 0.1%. And as France is skirting a recession, seeing no growth at all as well. And we can look at the UK, though, and we see here that the FTSE 100 continues to rise and is on track for another day of gains as it approaches the target we mentioned yesterday in Charting the Market, which is the 7,694 high from the 11th of January. And also eyes the basically October peak at 7,702. Above there, we have another potential resistance area coming in at the September high at 7,747, all of which are still within our sights. With regards to the FTSE 100, which interestingly enough continues its advance, having had a very lackluster start to the year. As you can see here, a pretty sharp sell-off followed by a very gradual advance, which then at the end of last week basically led to strong gains, taking the index higher. I'd also like to look at the Dow Jones Industrial Average, and you can see here that this is trading in a new all-time record high. Yesterday, it hit a new all-time record high ahead of today's Alphabet and Microsoft earnings, which are after hours, and ahead of tomorrow's FOMC meeting. And you can see here that we continue to rise, even though we've lost some upside momentum over the last few days at the end of the last week. This week kicked off on a more positive note on Monday after Friday's gains to new record highs as well. So here, further upside is most likely in store, taking us towards the 38,500 mark. And medium term, we could be even eyeing the psychological 40,000 area, provided we stay above the last reaction low, that is to say a low on this daily candlestick, which is lower than the one to its left and to its right. And that was made last Thursday at 37,756. So provided we stay above there, further upside looks to be seen in the days ahead. Now, moving on to the tech sector, which has obviously been dominated by AI-driven stocks. And you can see here the Nasdaq 100 also trading very close to its record highs made last week at 17,668, which is being targeted at the moment, a rise above which would take us probably towards the psychological 18,000 mark. But we'll have to see whether the results by Alphabet and Microsoft, which has briefly overtaken Apple as the world's most valuable company, can keep those shares on track and can lead to further gains in the Nasdaq 100. And here also the last reaction low was made on Friday of last week, and that came in at 17,353. As long as we stay above that low, further upside is likely to be seen in the days ahead as well. And then looking at Japan, you can see here that the Nikkei 225 made a new record high last week at 37,003 on this daily financial bed, then slid back slightly as the Bank of Japan retained its dovish stance as inflation in Japan slid again. And you can see here that on Monday, we basically rallied yesterday to 36,278, but earlier today came off again on this news that the Evergrande collapse is gradually continuing in China, and that all of basically didn't help Asian sentiment in that region with regards to stock indices, and here we're coming off. But basically, as long as we stay above last week's low, the low from Friday at 35,686, we could see a continuation of the current uptrend. Euro dollar has been interesting of late. If you look at the daily chart, you can see here on the daily financial bet that we have slid to levels last traded in mid-December of last year. So to a 6-week low as the euro continues to weaken. And as we see now, the European Central Bank, or expectations for it to cut rates, are becoming basically more dovish than that of the Fed. And it'll be interesting to see what the central banks will say in their commentary after the monetary meetings this week. The Fed meeting, obviously, on Wednesday, and the European Central Bank on Thursday. But so far on the currency pair, we've slid to 107.96. And so far, trading below the red line here, the 200-day simple moving average at 108.43, which continues to act as resistance, as it has done over the last week or so. And you can see here the previous week in mid-January, it acted as support. So resistance currently capping the upside for euro dollar. If we were to fall through yesterday's low at 107.96, we would probably head towards the November low, the early November low, high, I should say, 107.56, and the December low at 107.24. So that's the next downside target zone for euro dollar, provided we stay below the last reaction's high, which was made at 109.32 last week. Now, the euro remains weak also against the British pound, and you can see here the exchange rate dipped down to a 5-month low earlier yesterday at 85.14, and that took us back to levels last traded in August of last year. Before today, we managed to revert to the upside despite that very disappointing reading with regards to Eurozone GDP data. Now, the fact that growth in the euro area came in at 0.1% year on year, slightly better than the 0% expected, might have helped the euro to bounce back, as you can see here. Or maybe it just means that the market participants believe that the European Central Bank will keep its rates higher for longer, and therefore the euro might rise slightly against the British pound. But right now we're still in a downtrend. As you can see here, we remain below this December to January downtrend line, which currently comes in around 85.56. And as long as we stay below that, and also last Thursday's high at 85.64, the medium-term downtrend remains intact, and we could even slide further. Now, if we were to fall through last week's low at 85.14, the next downside target would be the 84.93 low seen back in August of last year. Now, another currency pair that is interesting this morning is the Australian dollar against the US dollar, because we slowly tried to leave this sideways trading channel, which we've been trading in, on weaker than expected retail sales in Australia, and briefly even rose to a new 2-week high at 66.24 before coming off again. You can see here the volatility is still very low in this currency pair, very little happening here, small candles on this chart. And right now, though, we are trading back above the red line here, the 200-day simply moving average at 65.78, which does have a little positive bias for the currency pair, together with the October to January uptrend line, which can be seen at the moment at 65.62. And this combined with the fact that we have now left this downward channel that we've been trading in since the beginning of the year, could indicate that we could, in the next few days, perhaps head back up again towards the orange line here, the 55-day simple moving average at 66.50. So that's a potential upside target. But as long as we stay below the high seen at the beginning of December at 66.88, the downtrend remains intact, simply because we still have a series of lower highs and lower lows on this currency pair. The oil price, interestingly enough, after having rallied and gapped higher yesterday, if we look at WTI, for example, you can see that here, to 78.87 on this front month futures contract, has come off as demand worries overshadow the escalation in the Middle East with the attack we saw, the drone attack by militants backed by Iran on a US base, a military base in Jordan, killing 3 US soldiers. And despite that escalation in the Middle East, the oil price yesterday came off from that high at 78.87 on this front-month futures contract to below the red line here, the 200-day simply moving average at 77.27, which currently acts as resistance. And so far, we've bounced off the January uptrend line, as you can see here at 76.38, and are just trading in a very low volatility sideways trading range. But if we were to fall through that uptrend line, we could not only fall back to the high seen at the end of December at 76.20, but also to the 22nd of January high at 75.45, which should then act as at least a short-term support, with the 8th of November low at 74.92. So that is a potential support area for the days ahead. For the bulls to be back in control and for the more gains to be seen with regards to the current reversal in the oil price to the upside. As you can see here, we've got this reversal pattern. What we would ideally need to see is a rise not only above yesterday's high at 78.87, but also above the mid-November and late November highs between 79.62 and 66. Another interesting commodity is the price of corn futures. And as you can see here, front-month corn futures are trading back at levels last traded in mid-January at 444 and look to be on track to fall through this low. And I have to move out onto a weekly chart to show you how far we would then get if we were to fall through that 444 low. Basically, we would be trading at levels last seen in December of 2020, and the next downside target would be the November of 2020 high at 438, ahead of the October of 2020 high at 422. So you can clearly see that the price of corn continues to slide. Yes, with regards to the speed of descent, it has declined as volatility is becoming smaller here on the weekly chart, but you can see the same on the daily chart. We have small bars, but the trend is your friend, and that's still pointing lower with regards to the price of corn. And I wouldn't be surprised if we have an acceleration to the downside once we were to fall through this 444 low, which incidentally also held yesterday because of stops most likely being triggered. That could then lead to an acceleration to that target I just mentioned at 438. And last but not least, I'd like to also look at Chicago wheat prices, which last week rallied on geopolitical tensions to 623 on the front-month futures contract, but have then since come back again. As you can see here, we're on track for our third consecutive day of falling prices with regards to US wheat prices. And we are now trading below the orange line here, the 55-day simply moving average at 607, and are heading back down again towards the November to January uptrend line, which currently can be seen around 585.50, and also towards the mid-January low at 581. So further downside quite likely to be seen over the next few days with regards to the Chicago wheat price. Now, if we were to fall through the current January low of 581, we could accelerate to the downside and retest the November low at 557 on this front-month futures contract, which together with the low seen back in September at 552 should act as pretty good support if that were to happen. Thank you very much for watching Charting Markets with me, Axel Rudolph. Please feel free to follow me on X. My handle is at AxelR_IG.